can see that. Yes, I think that's now recording. Okay, welcome. It's great to have you here. These sessions, as I mentioned, go on every Wednesday. They're all different subjects, and it would be always good to get your feedback on what you would like me to talk about on these sessions. Today, we're talking about how to think about your business or the other person's business during a divorce, because people often forget about their business. They often think the business is mine, so it shouldn't be included, or the other person has a business and they're saying it shouldn't be included. So it's always good to understand a bit more about how we look at businesses during a divorce. If you've been before, you'll know the session is about 45 minutes. I start off presenting some information to you, and then after that, you have the opportunity to ask me questions, whether it is about the subject that we're talking about today, or even anything else that's coming up for you during your divorce. You may have other questions. And while you're doing that, if there's anything you want me to talk about, if there's any subjects that would be really useful for you to learn about, then let me know, and maybe we can put on some sessions that fit your questions and the things you need as well. So yeah, looking forward to presenting this to you and hearing your questions. So yes, let's get started. Okay, I'm going to share my screen. And let me know if you can hear that, if you can see that okay. And I hope you can hear me all right as well. I'll keep an eye on the chat box while I'm talking, so feel free to put your comments and your questions in there, and I will start. And the reason why we're talking about this is because there's lots of things to think about. When you're going through a divorce, there's a whole load of things that you're going to be worrying about. And one of those things is the business. If you have a business in your name, if your husband or wife has a business in their name, or even if it's a business that you both jointly own, what happens to it during a divorce? And people really struggle with this because they think, well, the business is the other person, so maybe it doesn't need to be included. Maybe we just ignore that, or it's not a business that can be sold, so maybe that shouldn't be included. It's a marital asset, and you should be looking at how this is included in your financial disclosure, which is you putting on the table, being transparent about your assets and liabilities, and the other person doing the same. So it is something that needs to be looked at. It needs to be thought about. And if it has a value, and it usually does, then it needs to be added to your marital pot. It's very different to other assets. So it's very different to your family home. It's going to be very different to pensions and any other assets that you might have. It's not like a bank account necessarily that you can just go and say, this is the balance in the bank account, so this is what we need to look at. It's very different. So we need to think about how we deal with this. If you started the business prior to your marriage, you may argue that it's not a marital asset. And I'll talk a little bit about that as well. But before I do that, I should introduce myself. So that's an introduction of what we're going to be talking about today. You're here, so maybe you do know a little bit about me, but my name is Bhavna Radia. I am a former family lawyer. I qualified as a family lawyer in my 20s, and that's the work that I did for a lot of my career. I was in practice working for a firm, helping people through this process of divorce, and family matters generally, not just divorce. I got married when I was in my 20s as well, and believed that it was my happily ever after. Even though I helped people to come out of their marriages, I never thought that it was something that would happen to me. We went on to have 3 daughters together, me and my ex-husband. And as you know, from me calling him my ex-husband, I decided at some point during that marriage that this wasn't going to continue. It was a decision that took me years to come to. Really, I could have made this decision in year 3, but I was really scared to take that step. I was really frightened. I was really nervous. So many things held me back, and one of those was the fear of failure, the shame that it brought onto the family, and some of you will understand that. The stigma that divorce still has in my community really did stop me. And I know that my parents would have told me to try a bit harder, work it out. There's nothing that couldn't be resolved. And the families did get involved and, for many years to try and help us resolve the issues that we had. But I got to a point in 2011 that I decided that the marriage couldn't continue. I made that decision. My youngest was 1 year old at the time, so it was a really difficult decision to make. And I had taken a career break, so I wasn't working at the time, and 3 really young children to look after and bring up. And financially, it was quite scary. But I took this decision, I followed it through, and it's been 13 years now since we separated and the divorce went through. It was difficult. My mental health was, really low. The children struggled as well. But I have to say, once the divorce was done, there was this process of healing, coming to terms with our new life, stabilizing. And it's not a decision that I regret. I'm glad that I took that decision, even though it was difficult at the beginning. The children are much older now, and they tell me it was a really good decision, and they're glad that I took those steps because I needed to, but also they have 2 much happier parents as well. So that's a bit about my story. But during that time, I was lucky. I had legal knowledge. I was able to do all the work myself, take steps myself. We did use a mediator to try and get to an agreement, but that didn't work for us. We managed to get to an agreement outside of mediation. But I knew that I could take the steps I needed to do the legal work myself. And it saved me a lot of money. And I started thinking about all these people going through this process that couldn't save money because they have no choice but to pay thousands of pounds to a lawyer to do this for them. And it's because they don't have knowledge. And I was lucky that I did have the knowledge. And so these sessions are to almost give back, to help you with the knowledge that you need to make decisions. Hopefully, keep your legal fees down because that's really important. I come across so many people that have spent tens of thousands of pounds on legal fees. So I spoke to a lady last week who said her legal fees stood at £100,000 and she wasn't even halfway through. I spoke to somebody else who said just for a couple of, just to sort out the child arrangements, the beginning part of that, they'd already spent £100,000. And they estimated their legal fees would be about 200,000 by the time they finished. And they're not very wealthy. So this is unaffordable for people. That's not usual amounts. Usually people are spending 30,000 approximately for their divorce. And I wanted to bring a way of helping you with knowledge, but also to bring your legal fees down and to give you options to work differently to keep your legal fees down. And I'll talk a bit about that afterwards. But through my divorce, I understood what my clients needed and what they're going through. So all the work I do is to make it easier for you to navigate this process. But let's talk a bit about businesses and what we do with that now so that I can give you the information that I need to be able to, for you to ask the right questions and take steps that are right for you. With all of this information that I will give you, I have to say that obviously I can only give general information on this call. I don't know your specific circumstances. So it's really important that you understand your specific circumstances through the talk that I'm doing today. This can only be general. So just bear that in mind that I'll give you some examples, but they will be possibly examples that don't always fit within your circumstances, and you may need to get some guidance that fits your circumstances. But the first thing to think about is when we're looking at businesses is what are the different structures that a business can take? And it's really important to know this. If you are somebody that is coming across a business for the first time, maybe the other person's got a business and you've never dealt with it, understanding the structure, the legal structure is really important. Firstly, because if you've got a limited company or a partnership, they may be easier to sell on than a sole trader, because when you're a sole trader, the business is you and the work that you do. It may not be as easy to sell as a limited company. So it's understanding the structure first. So what is a sole trader? A sole trader is a self-employed person who owns and runs their own business as an individual. They've got sole ownership and sole control as well. Usually they own the business themselves, but it doesn't mean they don't have employees. They may have people working for them that help them carry out the activities of the business. As a sole trader, you and your business are considered one and the same. You're not a separate legal entity at all, which means that you're responsible for all the transactions and activities that your company's involved with. You're likely to pay income tax on any money that is a profit. So you will be registering for self-employed income and completing a self-assessment tax return to HMRC every year. A partnership is two or more partners that carry out a business with a view to making a profit. So, for example, solicitors' firms are often a partnership. They are limited liability partnerships. So both you and your partners are responsible for running the business and you share the profits between you. You're personally responsible for paying the bills. So it's almost like a sole trader, but there's two of you. And you have the documents to show how you share the profits. But you would be sharing the business profits, and each partner would pay income tax on their earnings and their share of the profits. The third structure here is a limited company. And this is a type of business that is incorporated at Companies House. And when you incorporate a company at Companies House, that company becomes a legal entity in its own right. So you are completely separate from your business. You may be a director in it, you may have shareholdings in your business, but legally the company stands on its own. It can enter contracts in its own name. It can buy property in its own name. It has its own bank account. So it's a separate legal entity to its directors and shareholders. There's lots of administrative tasks for a limited company. These are required under the Companies Act. And the interesting thing about limited companies is that you can go onto Companies House and get some limited information about each company. So if your ex-husband or wife has a company and you want to check that company out, go onto Companies House. You can search for companies under that person's name and it will bring in all the companies they own. You can check the accounts that they're filing. Your ex-husband or wife may have a company, and when you check, they've transferred that company into somebody else's name. So it's definitely interesting to keep an eye on Companies House as to the companies that your spouses may own or may have transferred. If when you're doing financial disclosure, which is being transparent about your assets and liabilities, if the person does not disclose a company that they have in their name on Companies House, you can call them up on that and get a valuation for it as well. Finally, the last structure that I've put here is a public limited company. This is quite a different type of company. It's recognizable because it has PLC after the name. These are big companies that have offered its stock on the stock exchange to the general public as well. So you can buy shares in these companies as part of the general public. They're quite complicated structures. I'm not going to cover them today just because most of you won't have a PLC company that you're dealing with. The first thing you have to do when you're looking at a company, if the other person has a company, is how do you value this company? We've looked a little bit about the legal entity of the business, And now we need to think about how the company is valued. We need a valuation for the purposes of working out a financial agreement, and also because the court will require you to do this. When we are looking at your assets and looking at how to get to a settlement, the first thing, as I said, we have to do is a financial disclosure exercise. And this is providing valuations of all your assets. Assets being property, savings, shares, investments, ISAs, cars, any asset above £500, pensions, any money owed to you. These are all assets. And a business is also an asset. You obviously could have liabilities as well, so credit card balances, a loan, money you owe to family or friends or another, say, company. Or a tax liability, that's a liability as well. So all of these things are liabilities, and we would do this exercise of financial disclosure where we find out what everything is worth. And the same goes for a business. We need to get a valuation of your business. And it's important to get a fair and accurate valuation of your business, just to ensure that this financial agreement that you're going to reach reflects a reality of your situation. Sometimes people will show a lower value than it's actually worth. Say, for example, the company accountant is preparing the valuation and they are very good friends with the owner. Sometimes it can be tempting to encourage them to put a lower valuation. And obviously this could be possible. You could put your business valuation as lower than the realistic valuation. But if the other person realizes this, it could open you up to financial claims even after everything has been finalized. And we've seen this where businesses have been valued quite low. We know the business should be more valuable. Even neither party wants to get an independent valuation, so they're stuck with the value that the other person has given. And later on, we realized that suddenly that business should have been worth a lot more. We can still open up the financial agreement, even though it's been through court. So it is tempting to go lower, but something to consider whether you put a realistic valuation in to start with. There are a few things that if you are getting your accountant to value, that they will look at. The first is assets, any assets that the business owns, any tools, equipment, vehicles, anything like that, or even intellectual property that the business owns. The accountant will also look at cash flow, previous cash flow, and also the forecasted cash flow about 5 years into the future. So say, for example, the business, the last 5 years, the business had been growing and the cash flow was increasing steadily. They can forecast what cash flow is going to look like in the future as well. And this will give us an idea of the value of the business, because if the business generates a good cash flow and that's increasing, then that can put the value higher. We're looking at profits, net profits of the business. If the net profits are steadily increasing, we would look at net profit in the past, net profit in the future as well, to get an idea. And some accountants will say the valuation of a business should be based on 3 times the last 3 years net profit. So say, for example, the average net profit was £100,000, then the business could be valued at £300,000. So that is a broad brush valuation. Sometimes it's not possible to value the business in that way. And it might be because the business activity, the business turnover comes from one person providing a service. So say, for example, an IT contractor. They do their work, they get a daily rate, and this goes through their limited company. But it's not a limited company that could be sold on, because you couldn't pass that to another IT contractor to run the business, because it's dependent on the owner of the business actually carrying out the activities. And if that's the case, we may look at the valuation based on projected income and balance in the bank. So if that business has £100,000 liquid in the bank, then it might be that we value the business at excuse me, 130,000, because we can see that that income is coming in, but there is a balance in the account as well. So that gives you a brief idea of how a business could be valued. But giving you a case study, if you've got a plumbing business that is set up as a sole trader, the owner of the business is a plumber and may have other plumbers coming in to help out. The business could be valued based on the assets. So you might have vans, you could have equipment, you've got tools, and they can be quite valuable. Then we would look at the turnover of the business and the cash at bank and net profit. So all of these things would give us an idea of how the valuation of that business should be. So the accountant would need to value that, but they would value that based on a plumbing business that is a sole trader. So this business could be sold as a going concern, but the new owners could put it into a limited company. So it could run without the owner, and it could be a business that's sold easily and therefore be worth more. Some businesses don't have assets, so you wouldn't take that into account. For example, as I mentioned, an IT contractor, they're not likely to have a lot of assets. They may have some laptops, a printer, and some other sort of computer assets like that. But they're not generally valued very high anyway. So we might look at what's in the business bank account and what sort of contracts the person has to get a valuation. Often I see that the valuation is the sticking point of a business when you're getting divorced, because if one party is involved in the business, then the other person might feel that that person is giving a very low valuation. And I've got clients at the moment that are going through this. The business has been valued very low. We know that the business has got really good contracts, really good cash flow. We can see the growth based on the previous accounts, and we can see what the projected future growth is. But the business valuation doesn't reflect this. And often this is the case when you're getting divorced, because you might find that that person has a good relationship with their accountant, and the accountant is happy to value the business a bit lower than it should be. But what you can do in that situation to get a true valuation is to instruct a joint valuer to value the business independently of the accountant, independently of the two of you, and you decide that you will take whatever valuation that independent valuer will give. So if you were going to court and one of the sticking points was the valuation of the business, this is what the court would order, that an independent valuer is instructed, that you jointly share the fees, and that you take whatever valuation they give as the value of the business. So that's how we can deal with the valuation. So assuming you've got the valuation now, you've agreed it, whether it is through the accountant's valuation or whether you ended up getting an independent surveyor. Now that you've got a valuation, what can you do with the business? People get very confused on what can happen with a business during a divorce. The first thing we have to say is that you can't take the business in isolation. The business is part of a whole group of assets that you will have, and we have to look at the whole rather than just the individual. When we do financial disclosure and we get an idea of what everything is valued at, we then have to look at what your needs are. What do you need for housing? What do you need to make sure that you've got income coming in? What do you need to make sure that you've got money on retirement as well? So we need to look at all these different things, and then we structure the agreement to fit all of these needs for both of you. And the way we have to look at the business as part of this is via either offsetting, buyout, keeping it as it is, or selling. So those are the different options you may have for a business. Offsetting is where one person, for example, will keep the business, and that's possibly the person that's been running it. If they've been running it solely, they would keep the business, they would keep the income, and the other person would get assets, different assets of an equivalent or greater value, for example. So it might be that one of you is running the business and wants to continue running it. You would keep the business, the shares would be transferred into your name if you have got a joint business, say with both of you having shares. The shares are transferred into your name. The other person may keep the family home instead. And we kind of build out a proposal based on that. For example, if there is a business that is in your sole name, you would keep that and the family home would be transferred. But it might be that there's other assets like pension assets that the other person may have a bigger pension and you've got the business, but you don't have a pension. So you may offset it like that. You're not even transferring assets. But when we're balancing the family assets, we're looking at it that way, that you've got your business, the other person's got their pension, and that's almost equal. Obviously, businesses come with a risk as well. You can't just say it's an asset, but you have to make a measured decision on that. You might value the business at 100,000, that's accepted by the other person, and you're running this business 2 years down the line for whatever reason that business fails. But the other person has got the family home and that's only gone up in value. So you kind of need to balance this carefully to make sure that you understand how long that business could run and whether you want to offset it in that way, because obviously it comes with risks. The family home can go down in value as well, but it's likely over, say, a 10-year period, it's likely to go up. If both of you own the business together and are both involved day to day, what do you do? And again, it might be that one spouse buys the other one out, because it might be that you don't have enough other assets to offset. So you could look at it so that one person keeps the business, the other person gives £50,000 for that person's share. So that person, second person gets £50,000 but transfers their share to their ex-husband or wife. So that's a buyout. And if you're both directors and both shareholders, that buyout would mean that if you're keeping the business, all the shares are with you, the other person comes off as a director and you would then be the sole director. So that would be a transfer that happens, and the lump sum would need to be paid. So an example, if we do it as a case study, we've got a couple that own and manage a restaurant. I'll call them Anna and Bob. Based on an independent valuation that they had instructed a valuer to do, they agree that the fair market rent of the restaurant, including the property, the going concern, all the assets, is £1 million. So this business is valued at £1 million. Anna wants to continue to run this business. She wants to own it. And Bob actually wants to open up his own restaurant in a different location because he's thinking of moving. And in order for him to get half the value of the business as part of the divorce, Anna could purchase Bob's interest at an agreed amount. So that way Bob has got money to start his restaurant and Anna could possibly get a business loan to pay him that money. It might be that they've got a family home and Bob keeps the family home and Anna keeps the restaurant instead. So that's offsetting. These are different ways that you can look at the business. Other options could be that if the business produces a reasonable income but doesn't have much capital value, then what you may agree is that you will give the other person maintenance instead, because maybe you can't raise a lump sum, but from the business profits, you could pay them, say, £1,000 a month for X number of years, so that that's similar to the lump sum they would have got. So that's another way of doing a buyout if you can't raise the funds straight away. The other thing that people consider is whether they remain as co-owners. And I have had clients do this. They own the business together, it's a family business, and neither of them want to leave the business. So they continue to run it after their separation and divorce. They run it together. Obviously, when we're going through a divorce, what we're trying to do is give you a financial clean break. So you own your assets in your name and the other person owns their assets in their name. If you keep the business together, quite clearly, you're not getting this financial clean break, which is the ideal. But sometimes it's the option that people go for. Personally, I think it's a difficult solution because if you've been married and now you're divorced, running a business together can be really tricky. You are then making decisions day to day together. You're dealing with staff, you're dealing with finances, you're making really important decisions together, and maybe you're not getting on too well. So, this can cause all sorts of issues, and I've seen these issues occur. If this is something you want to do, because maybe you started this business together many, many years ago, and both of you want to keep running it, then make sure you've got a formal written agreement. It's almost, once you're divorced, this is almost like both being strangers running a business together. So you want to have a formal written agreement on who's responsible for what, who makes decisions around what, how does the profit get shared, what shares do you both still own. The other thing is selling the business. If it is a business that has good resale value, then you could sell. You could find a buyer. You could get some money coming in, which then could be shared in agreed percentages. So you may say that a business that's worth £1 million is put on the market. Whatever you get, you take 50% each from the proceeds after all expenses. So that could be another thing that you go for. But depending on the option that you choose for your business, there could be tax implications and other considerations. So do consult your accountant, do consult an independent financial advisor as part of divorce proceedings to understand the tax implications and other implications of the option you choose for your business. There could be capital gains tax. There could be income tax considerations as well. So lots of things to think about when you are looking at a business during divorce proceedings. These are the common ways that people deal with private businesses in a divorce, but they're not the only way. But they're the sort of the simplest ways that I could explain and the most common ones as well. But take into account, when you're looking at all of this, take into account everything, not just your business. Take into account the income the other person has coming in, the income you might have coming in from the business, the risk that you're taking on by keeping a business, but also all the other assets that are in the pot, so that you can look at the pros and cons of all the options that are available to you, and whether you think keeping the business is the right option. Ultimately, it's one part of the picture, of a bigger picture of your assets and liabilities. So when we look at your financial settlement, taking your business into account, what we are looking to do is to come up with a fair and reasonable agreement for both parties. And fair and reasonable is something that is not morally fair and reasonable, but it's a legal term. And there's lots of different aspects and factors that we need to take into account to work out whether an agreement is fair and reasonable. One of them is needs. What are your housing needs? What are your income needs? What are your pension needs? And then basing all these factors and all your needs, taking all that into account, we then can look at your assets and work out what could be a settlement that is right for you, including the business. So hopefully that gives you an idea of a little bit about what a business could look like, how to value it, and what you can do with it as part of a divorce settlement as well. And I can see that there's some questions in the chat box. Feel free to put more questions in the chat box and I'll come to them at the end. But while you're doing that, I'll just take you through a little bit about how to work with me. My primary way to work with me is through my support program. And this provides 6 months of support and guidance. I'm not doing everything for you. I am not your lawyer through this process. I am your mentor and your guide. for you to do it yourself. So it's effectively a DIY divorce with somebody guiding you. So it's that middle ground. Lots of people would say, I want to do it myself because I don't have 50,000 to give to a lawyer, but I'm really scared because I don't know how to do it. I'm really scared because I don't have the knowledge on the process or the knowledge on how to fill in these forms and documents that I need to prepare. That's where I come and bridge that gap for you. I'm that middle person that helps you to do it yourself. Keep your fees fixed. I offer a fixed fee. But through that fixed fee, I'm not saying I'll only help you with your divorce and finances. I help you with anything that comes up around your separation and divorce. I help you with correspondence, communication, documents that need drafting, applications that you need to prepare. And it's really difficult to let you know exactly the applications you will need. Because, for example, you might start a divorce application and the other person does not accept service of it. There may be some further applications we need to put through the court to make sure that goes through, even if the other person's being difficult. We may have financial proceedings to start, and that's a different application. So I don't look at the things that we're working on. I look at 6 months for a fixed fee, and we work through everything we need. So through my process, I would help you with your divorce application. We look at financial disclosure. We look at the valuations of everything. We are coming up with proposals. It may be 5 or 6 proposals. And then we choose one that is in your advantage. We look at the pros and cons of it, whether we can actually make it happen. Is it viable? And then we look at actually how do we negotiate this with the other person and get to an agreement. And then once you've got to an agreement, how does this need to be documented to make it legally binding? And this is also the case with child arrangements. So the plans you need to make for your children. It comes with a supportive community and other experts as well that are there to guide you. As I said right at the beginning, I do this as a fixed fee to keep your fees down, but to give you the confidence to take steps yourself so that you're not paying £50,000 for the help that you will need. I get lots of testimonials from clients, lots of reviews, and these are some comments that people have put into our chat for the community. So you can see the different things that people are saying. And I can always share more of these. There's plenty of them. So if this is of interest to you, if you are thinking that you want to know more about the program, then I do offer a call where I can talk you through how the program works, whether it's right for you, and you can ask me any questions you have. Feel free to ask me questions today as well, of course. Nelma will put that link to book a call with me in the chat box. There you go. So feel free to book a call and let's see how your situation is and whether the program is right for you. I also have a book which can help you take steps forward around finances, around the child arrangements, but also your mindset. Because sorting out your mindset, getting a strong mindset during this time is really important. This is available on Amazon and it comes with downloadable resources as well. Different ways that you can get in touch with me, Facebook, Instagram, website, and I need to add YouTube on there, and Nelma's already put that on in the chat box, LinkedIn, and email as well. So feel free to get in touch if you've got a question, if you want to give me feedback on this session, or if you want me to talk about different things that maybe I haven't covered in the past. Okay, so I'm going to stop there and I will look at your questions. Let's have a look. My mum and I purchased a buy-to-let property in 2007. It was transferred to my wife and I in 2019. We separated in 2022. Is it possible to divide this now based on the year's ownership instead of 50-50? Okay, let's have a look. So what you're saying is this was only a marital asset for since 2019 because it was transferred into your name. could it be that it is looked at just based on the number of years? I think it's 3 years that you've owned it. It does become difficult because you made it a marital asset by putting it into your wife's name. So generally, it's not 50-50. It wouldn't have to necessarily be 50-50 that you divide that buy-to-let into. You could say that that was a non-marital asset for many years, and so it would be the right thing to look at that and only put part of it in the marital pot. It's not necessarily the legal answer, it's more the moral answer, but legally, because it's in joint names, your wife and yours, it would go fully into the marital pot to be shared, especially if even when you owned it with your mum, if you use the proceeds, the income from that, for the family. So you spent it on holidays, for example, you may have taken that income and put it into the family home renovations, anything like that. You've included it in the family assets way before you transferred it. So it depends what you've done with the asset. And I guess you're saying there the purpose of the transfer was that wife was not working at the time due to childcare. You needed to show an income for the wife to raise capacity to purchase the matrimonial family home. My mum is frustrated with her decision to transfer the buy-to-let due to her investment and commitment to maintain the property throughout. Yeah, I completely understand why your mum would be frustrated. But by putting it in your wife's name, you have put that asset as part of the family pot because your mum, it shows that your mum intended for it to be an asset for you and your wife. Even though I understand lots of people do this, they put assets into the name of the other person just for tax purposes, possibly, as you say, to show an income. But there was a chance that that property would have been part of your marital pot, or at least half of it could have been part of the marital pot in any event. But it depends. And you'll find that with legal questions, there's always a grey area. And the answer is it always depends on your circumstances. So sometimes it's not possible to say completely without knowing a lot more. Is the prenup agreement valid? We done one before marriage. Marriage is 12 years old and 2 kids, 6 years and 11 years. Prenup term already expired after the first kid's born. Need to review the agreement, but we didn't do it. Okay, so a prenup is not legally binding in this country. It is in other countries. What you will find with a prenup is that it shows intention to the court. So if you had a prenup that you signed prior to marriage, the first thing you need to do is make sure that both of you have had legal advice, independent legal advice, on the contents of that prenup. So if you drafted the prenup yourself and you both signed it, it gives it less weight. If you both had legal advice on the terms of that prenup, there's a bit more weight attached to it, but it is not completely legally binding in any case. Through divorce proceedings, if you have a prenup and a judge is looking at that prenup document that you signed, as I said, if you had legal advice, they would say that actually it's not legally binding, but I'll put more weight on it. But your situation may have changed since you signed that prenup. So you've got children now, and having children changes everything around a financial agreement during divorce proceedings. So, I mean, you said that the prenup had a term and that's expired anyway. You didn't review the agreement and get another one signed. That would have been called a postnup, not a prenup. And again, a postnup is not necessarily legally binding either. What a court will do if you come with a prenup, postnup, and then a whole set of circumstances is decide based on the circumstances whether they should follow through with the prenup or postnup, or whether they need to come up with a different settlement that is fair and reasonable in the circumstances. But the prenup shows intention, that you had intention that, for example, if the person that wrote this in the chat box, if you had more asset, that in the event of a divorce, you would keep your original assets, if that's what you wrote. The court would look at that and think, okay, that is what the parties agreed, but they've now got children, and the children need to be cared for. There's not enough asset here for you to take everything that you came into the marriage with, which is what your intention was. But you would need to share a bit of what you came into the marriage with, because the children need obviously a family home. There may not be many other assets, but they would recognize that the intention was for you to leave the marriage with a bit more. So you may still get a better settlement than you would have got if you didn't have a prenup. I hope that makes sense, because it is quite a complicated subject. But again, it depends on the circumstances. It's a grey area. So there's no set answer on that, but it would be something that a prenup would be something that a court would look at. Just wondering how my business be tackled with the divorce. So I'm a doctor who uses a limited company as a tax vehicle. There is only one director and 100% shareholder. There's no assets, as we claim everything we buy for the business under the AIA ruling, so everything gets written off. There's hardly 20K in business for running costs. Turnover is between 70 to 100,000, and all the money in the business. I am whole and sole owner of the company, have bought equipment for work purposes, which I use on a daily basis and can't sell. I also work as a salaried person and earn 30K. She earns as a doctor, part-time, 80 to 100K. So with your business, it's similar to the IT contractor. It's not a business that is a business similar to any other business. What it is a tax vehicle, as you've stated, and IT contractors will use it as a tax vehicle as well. So your business may be just the money that's in the bank account that is taken into account. Your income that you receive as the business owner and as the salaried employee, that would be the income that you would declare as your income. So it may be just the money that's in the bank that would be the value of that business. Okay, so you've given me an idea of your pensions. My limited company, how would this be treated, as there is nothing in the company left and the turnover has gone down for me working less due to my health and stress? The only asset we have is a family home with equity. And when you say outstanding balance, I presume that is the mortgage. Had my FDA, waiting for FDR. I have been thinking of wrapping up the company. What would you suggest? Well, so it's very difficult for me to suggest what you should do because I don't have enough information. But if you feel that you don't want the business anymore for tax purposes, then you could wrap that up. Speak to your accountant, because it's likely that there could be some tax implications. If you've got 20K in the business bank account, that might be allocated for tax already. So speak to the accountant as to what you need to allocate for tax purposes and anything else to wrap up the business. There may not be anything left. Your business is very different to, say, a business that has a turnover selling products, for example, because they may be assets. The stock is an asset. There's a customer base. You don't really have a customer base. You're not really a going concern, not a business that can be sold. So your business valuation will be very limited. I don't necessarily think selling the business sounds like a good idea just based on the information you've given, because I don't think your business has much of a value anyway. You don't need to transfer shares or anything else. So if it was me, I'd probably keep the business and allocate, if you've got some taxes due, your 20,000 in the bank may be allocated for some expenses anyway, which might mean that there's no valuation there of that business. It is just a vehicle to save tax. And obviously your business expenses go through that as well. So from that point of view, I don't necessarily think selling it is going to give you anything different. It's just your income that you're taking into account from the business and from being a salaried employee. Same for your wife as well. It will be her salary that's taken into account from a point of view of income. You've got pensions as well that need to be taken into account. Let's just see. Your pension is slightly higher than hers, but it doesn't necessarily mean that a pension share is right for you either. Might not be because of the costs involved in a pension share. But it might be that you take account of your higher pension from whatever happens to the family home, which could be that it's transferred into one person's name and the other person gets a lump sum. It could be that the family home is sold and the proceeds split. Finally, it could be that it stays in joint names and there is a date that that property is transferred or sold into one person's name. So lots of different options for you. But as I said, it looks like selling your business wouldn't, or closing your business down wouldn't be the best thing for you. But also you're looking at the whole settlement as well. So I hope that's been helpful. I'll leave the questions there. Do come back to me if you think that you would like to know more about the program. Nelma will drop you some details, but we can also book a call as well. It's lovely to speak to you, and do enjoy the rest of your day and catch up with you very soon. Take care.